What is the difference between an annuity and drawdown? When we come to retire, we need to decide what type of income we want or need from our pensions. An annuity is one option, and drawdown is a very, very different option in terms of extracting an income from your pensions. Firstly, an annuity. An annuity is a guaranteed income, usually for the rest of your life. What you do is you take your pension pot and you hand the pension pot either entirely or after taking your 25% tax-free cash, what's left, you hand it over to the annuity provider, often an insurance company, and in return, they will provide you with a guaranteed income, which is usually for the rest of your life. Now, the benefit of doing this is you know that as long as you live, that income will be maintained because the insurance company is actually committing to paying that steady, presumably monthly, possibly annual income to you for as long as you're around and as long as you are here to receive the income. So it's a really predictable way of ensuring that you have income throughout your retirement. However, there are some issues around annuities whereby people feel they may not necessarily represent the best value. In particular, unless you build in some kind of guarantee period or a dependence pension, when you pass away, that annuity income will stop. If that happens in the very early years of retirement, you might have handed over quite a significant lump sum to the annuity provider, only to receive a very short period of income back. It's actually based on your age and often sometimes health as well, in terms of how much income will be given to you. So if you're expected to live a long and healthy retirement, the annuity provider is likely to provide you with a lower monthly income amount than if you were perhaps much older or in poor health. The other thing with annuities, which is becoming a little bit of an issue, is the fact that they are based on interest rates, and interest rates aren't really going anywhere. And because interest rates have been quite low for quite some time, annuities might be perceived as being poor value compared to the return that one could generate from an annuity, say, 20 years ago. And that's because back then interest rates were much higher. So the income that you received in return for the lump sum that you handed over was more attractive. That being said, if an annuity will provide you with a level of income which is sufficient to meet your needs and to allow you to have the standard of living in retirement that you would like, it's certainly not to be overlooked. On the opposite side, we've got pension drawdown. So drawdown is where you leave your money invested in your pension throughout your retirement, and you simply dip into the pot to provide yourself with the income that you need. This might be a regular monthly amount, or potentially it could just be ad hoc lump sums as and when you need a bit of extra money to pay for things like holidays or a new car. The downside with drawdown is there are no guarantees. Your money is invested, and as we know, and as if you've looked at your pension throughout your working life, you've probably witnessed, investments can go down as well as up. So if you're in drawdown throughout retirement, you never have an absolute guarantee that your money will last you a certain length of time, because you don't know how much it's going to make, or if it's going to fall at certain points, how much it's going to fall by. However, it is invested, which means that you can benefit from long-term investment growth. And if your retirement is going to be, for example, 30 years, that's a really good period of time to benefit from investment growth. And it may well be that your pension funds can appreciate in value if they grow at a rate which is faster than the rate at which you're spending your money. When you die, any money that's left in your pot will be left to your beneficiaries as well. So this is a real draw for a lot of people who want to make sure that the value of their pension pot doesn't disappear if they don't live a long retirement. So for example, if you didn't survive more than a couple of years and you'd only had a couple of years worth of income in retirement, anything that's left in that pension pot wouldn't fall into some black hole and disappear. It would go to whoever you'd nominated as a beneficiary, be it a spouse, a partner, or children. So there really is a perceived value in pension drawdown in that the pot remains yours to be passed on to your beneficiaries, even if you don't get to the point where you've been able to spend it all yourself. There are real pros and cons to an annuity or drawdown. They really are opposites in terms of methods of income extraction. They both have big pros and also some cons as well. It's important to make sure that you weigh up both options, look at the annuity rates that can be offered to you. In other words, how much income would you get if you bought an annuity, before then deciding one way or another which method would be best for you.